This video will walk you through the solution for exercise 17-10, which focuses on accounting for various equity transactions. Here's the data for our problem. Ocampo Inc. reported the following amounts in the shareholders' equity section of its December 31st, 2026 balance sheet. The company had preferred shares that pay a $2 dividend, 10,000 shares were authorized and 4,500 issued. The carrying value is $225,000. The company had common shares, 100,000 authorized, 35,000 issued, with a carrying value of $280,000. There's an existing contributed surplus balance of $7,000. Retained earnings is $590,000. And other comprehensive income has a balance of $115,000. The contributed surplus balance arose from past reacquisitions of common shares. And during 2027, the following transactions occurred in the order listed. We will deal with each of these individually as we go through the requirements. There are two requirements for this problem. Requirement A asks us to prepare the journal entries to record the 2027 equity transactions. So let's begin with the first one, where the company issued 5,000 common shares at $9 per share. This is a pretty straightforward entry. The company is going to debit cash for $45,000, which is 5,000 shares issued times the $9 share price, and will credit common shares for that amount. In the next transaction, the company reacquired 10,000 of the outstanding common shares for $14 per share and canceled them. The first thing we want to do here is determine how much we're going to debit the common shares account for. We're going to debit it because by reacquiring shares, the company will reduce the number of shares and the associated balance carried on the balance sheet. To do that, we have to first determine what the average issue price or book value per common share is. So we're going to take the $280,000 beginning carrying value plus the $45,000 from the previous transaction where new shares were issued. And then we're going to divide that sum of $325,000 by the total number of shares at this point in time, calculated starting with the 35,000 shares that were outstanding at the beginning of the year, plus the 5,000 new shares issued, or a total of 40,000 shares. So $325,000 divided by 40,000 shares is an average issue price of $8.125. We then take that average issue price and multiply by the 10,000 shares repurchased. That's a total of $81,250, and that's the amount we're going to debit the common share account for. Now let's leave a couple of spaces. The easiest item to deal with here is cash. The company paid $14 to reacquire 10,000 shares. That's $140,000. Now, you may have noticed here that the company paid $14 to reacquire shares with an average issue price of $8.125 per share. That means the company paid more to reacquire the shares than it received for them. Therefore, the next item to look for is any existing contributed surplus balances. We're told in the data that there's an existing balance of $7,000 that arose from past reacquisitions of common shares. So the first thing we have to do is use up any existing contributed surplus balance pertaining to the same type and class of shares. If the contributed surplus balance were related to preferred shares, we couldn't use it. But because it resulted from previously reacquired common shares, we can use it. The balance is $7,000, so we will debit it to use it all up. And then the remainder, or the amount to make the journal entry balance for debits to equal credits, is $51,750, and that's going to be debited to retained earnings. The difference has to go to retained earnings because the company cannot record any gains or losses on transactions relating to its own shares. In the next transaction, the company declared a 10% share dividend on the outstanding common shares, when the ex-dividend price per share was $16. To record a share dividend, we're going to debit retained earnings for the number of shares that are outstanding, multiplied by the size of the stock dividend, and then the current share price. So the company started with 35,000 shares, it issued 5,000 additional shares, and then in the last transaction repurchased 10,000 shares. This now is 30,000 shares. We multiply that by the 10% stock dividend, or 3,000 shares, and then by the $16 share price to give us a total of $48,000. The company will debit retained earnings and credit dividend distributable. This is a temporary contra account to retained earnings, where we park the dividend before it's actually distributed due to some administrative timing delays in actually distributing the shares to shareholders. In the next transaction, the company issued the share dividend. The company is going to debit the existing balance in the dividend distributable account for $48,000 and credit common shares for that amount. In the next transaction, the company exchanged 1,000 preferred shares for a piece of vacant land. The land's fair value is determined by a qualified appraiser was $19,000, and the shares were actively traded on this day for $21 a share. One of the questions that arises for students is which value do you use, the $19,000 for land or the $21 share price? In this case, we're going to use the land for a couple of reasons. First, the land value is determined by a qualified appraiser. And second, the value of land doesn't fluctuate on a daily basis like shares do. So today the shares could be $21 a share, tomorrow they could be $15 a share. In essence, the land is a more stable asset, and that's what we're going to use. So the company will debit land and credit preferred shares for the land's fair value of $19,000. And then finally, for the last transaction, the company declared and paid the preferred share dividend and a $1 per share dividend on the common shares. So the company is going to debit retained earnings and credit cash for a total of $44,000, and we'll break that calculation down starting with the preferred share dividends. The number of preferred shares outstanding is the original beginning balance of 4,500 plus an additional 1,000 shares from the previous transaction in the exchange for land. That's a total of 5,500 shares, and the preferred shares pay a $2 dividend, so that's a total of $11,000. Then the common shares, we go back to the very beginning, there were 35,000 shares outstanding, plus an additional 5,000 issued, minus 10,000 reacquired, plus 3,000 from the 10% share dividend. That's a total of 33,000 common shares, and we multiply that by the $1 per share dividend for a total of $33,000. The sum of those two is $44,000. So we'll debit retained earnings and credit cash. The second requirement, B, asks us to prepare the statement of changes in shareholders' equity for the year ended December 31st, 2027. The net income for the year was $120,000, and other comprehensive income resulting from a revaluation of property, plant, and equipment was $23,000. So let's construct our statement of changes. First, let's get down all the columns. We're going to have a total column, which could either be on the left side or the right side, depending on how you like to put it together. And then we list all of the accounts that are provided in the original data. So we have a column for preferred shares, common shares, contributed surplus, retained earnings, and accumulated OCI. Then we put our beginning balances in. The preferred shares were $225,000, common shares $280,000, contributed surplus $7,000, retained earnings $590,000, and the accumulated other comprehensive income $115,000 for a total of $1,217,000. Then we start to complete our table with comprehensive income. Our first item is net income, which was $120,000 provided in the instruction. So that's going to go in the retained earnings column and in the total column. Then there's $23,000 from the revaluation of property, plant, and equipment. So we're going to add that to the accumulated OCI column and then include it in the total column. When we combine our net income plus any changes in OCI, that gives us a total comprehensive income amount. So in the total column, $143,000. We don't include that total in any of the other columns, and it's just meant to be a subtotal of the net income plus any OCI revaluation. So make sure you don't double count that amount in the final total calculation for this column. Now we'll deal with shares issued and retired. The company issued $19,000 worth of preferred shares and $45,000 in common shares for a total of $64,000 in shares issued. Then during the year, the company retired common shares, and in that transaction, the company reduced the common shares by $81,250. It used up the $7,000 contributed surplus, and the balance of $51,750 was removed from retained earnings. That's a total of $140,000. And then finally, we'll deal with all the dividends. The company paid the common share dividend of $33,000, comes out of the retained earnings and included in the total column. Then there was the $11,000 in preferred share dividends, again, reducing retained earnings and included in the total column. And then there was the share dividend on common shares, which is valued at $48,000. That reduces the retained earnings, increases the amount in the common share column, and has no impact on the total. As a result, the closing balances on our accounts are $244,000 for preferred shares, $291,750 for common shares. The contributed surplus balance is now gone. The retained earnings is $566,250, and the ending balance in the accumulated other comprehensive income account is $138,000 for a total of $1,240,000. It's also important to note that any additional details of the transactions and the authorized and issued shares would be contained in the notes to the financial statements. So if readers wanted further information, that's where they would go. And that's it. We're done with this problem.